What if the world's richest investors suddenly decided America was no longer the safest place to keep their money? Billionaires are now dumping their investments in the United States, and they are dumping it fast. Nearly $2.7 trillion was wiped out in a single trading session, erasing weeks of gains and shaking the confidence of global investors. And we are hardly exaggerating. Analysts then reported that the broader pullback had already erased over $4 trillion in market value, and in one brutal two-day stretch, a staggering $6.4 trillion disappeared from U.S. stocks. Now, several investors are saying they are scared for the U.S. economy. To make matters worse, President Trump is making a desperate call to Xi Jinping, begging China to step in and save the U.S. economy. This is no coincidence. The very trade deal between the U.S. and China, long described as a bedrock of economic stability, is about to crash. That trade deal unraveling would strike a brutal blow to an already fragile economy. For Trump, another face-off with China could be devastating, but he may have no choice. Some of the world's biggest investors are publicly saying the U.S. economy can no longer be trusted. There are growing fears that the debt is out of control, that confidence in the U.S. dollar is draining, and that long-term U.S. bonds are no longer safe. That is why the serious money, the smart money, is already repositioning. But before we dive in, make sure to subscribe to the channel. It really means a lot to us. Now let's get into the video. According to veteran bond investor Jeffrey Gundlach, America's debt burden has reached a point where it is becoming increasingly difficult to sustain. With federal deficits now above $2 trillion, and the Congressional Budget Office projecting the debt-to-GDP ratio to hit 122% by 2034, investors are warning that the U.S. is losing the stability it once took for granted. Gundlach says the shift is already visible in the markets. Treasury bonds, long considered the safest asset in the world, are beginning to lose that reputation. At the same time, something even more alarming is happening. Both U.S. stocks and the dollar are falling together. Normally, when stocks drop, investors flee into the dollar as a safe haven. But during the recent sell-off, the dollar weakened instead, a signal that investors are pulling money out of U.S. assets across the board, not rotating within them. Adding to the pressure, long-dated Treasury yields jumped, behaving opposite to traditional crisis patterns. When yields rise while markets fall, it suggests investors want higher compensation because they see higher risk. Here's the hard truth. America has borrowed and spent so aggressively that its margin for error has almost disappeared. If interest rates rise to just 6% or 9%, the cost of servicing the federal debt could consume half to more than 3/4 of all tax revenue. At that point, the government would be paying for past spending instead of future growth, a path no economy can sustain for long. The first issue is the scale of foreign ownership. Today, investors from overseas hold about $9.25 trillion in U.S. Treasury securities. Foreign investors also own around 30% of U.S. stocks, which adds up to nearly $18 trillion. Next, think about how America sees itself. The U.S. speaks loudly about being the strongest economic force in the world. It claims to hold all the leverage in trade, currency, technology, and finance. If those investors were to slow their investment, reduce their bond purchases, or shift their holdings elsewhere, the impact on America would be immediate. Interest rates could rise quickly. Stock markets would feel the shock. The dollar could weaken. Unfortunately, both of these situations are already happening. Stocks are down and the dollar is struggling. The idea that America is fully in charge becomes much more fragile when you realize that its strength partly rests on foreign confidence and foreign patience. Can a country be truly powerful when it depends so heavily on outside capital? If foreign confidence in U.S. assets is weakening, the next question is obvious. Where will America turn for fresh capital? With China, Japan, and Europe already holding vast amounts of U.S. wealth, Trump's strategy shifts toward the Gulf, courting Saudi Arabia, the UAE, and Qatar as potential lifelines for the American economy. This pivot transforms the story from dependency to diplomacy, showing how financial survival now hinges on new alliances. Donald Trump is beginning to understand a harsh economic truth. Without foreign investors, the American economy will struggle to stand on its own. With China, Japan, and parts of Europe already holding vast amounts of U.S. assets, trust is wearing thin. Trump's tough rhetoric and unpredictable behavior have driven some investors to reconsider their exposure to the U.S. economy. That is why fresh commitments from the Gulf are now seen as a critical lifeline. Saudi Arabia, the UAE, and Qatar are being courted like never before. Trump is offering access, deals, and political favor in return for investment. His calculation is simple. If Arab sovereign wealth funds begin pouring billions into U.S. infrastructure, technology, and finance, it could offset the possible retreat of Chinese and European money. In other words, these Arab partnerships are emerging as a key buffer against further market pressure. The recent push for strategic partnerships with the Middle East is not just diplomacy, it is economic insurance. Trump is counting on more than $2 trillion in new investments from Arab nations to shore up his economy. According to the White House, the UAE has committed to a $1.4 trillion investment framework over 10 years. Saudi Arabia has pledged $600 billion, including a $142 billion arms deal. Qatar has reportedly agreed to a $1.2 trillion economic exchange with the U.S. These pledges, announced earlier in 2025, are starting to show real momentum and could help calm nervous markets. If these investments come through, they could be the ones that prevent a deeper sell-off and give the U.S. breathing room. Stay with me, because next we'll see why, even with Gulf support, Trump still had to pick up the phone to Xi Jinping. But even as Trump courts Saudi Arabia, the UAE, and Qatar for billions in fresh investment, he knows that Arab capital alone cannot solve America's deeper vulnerabilities. The real leverage still lies in Beijing, because China controls rare earths, holds vast U.S. assets, and can shift global markets with a single policy change. That is why Trump's next move takes him directly to Xi Jinping, signaling a pivot from Gulf diplomacy to a high-stakes negotiation with China. When Donald Trump announced he would visit China in April after a phone call with Xi Jinping, many people saw it as a surprising reversal. Take note, Xi Jinping has refused all invitations to go to the White House. He knows he does not need to beg the U.S. for a trade deal. Xi realized that the U.S. needs China more than they are ready to admit. For years, Trump took a hard line on China, slapping it with tariffs, threatening 100% duty hikes, and publicly calling out its economic practices. But now, this April trip reveals something more urgent. He realized he badly underestimated how powerful China is, especially when it comes to rare earth minerals and global leverage over U.S. industries. Rare earths are a huge deal, and China dominates the global supply chain for rare earths. Without them, the U.S. would struggle to make critical technology, including defense systems. In 2025, Beijing imposed stricter licensing rules on rare earth exports, raising fears that it could choke supply to the U.S. A major vulnerability. By agreeing to delay those export restrictions for a year, China has eased some of that pressure. But make no mistake, this is more of a strategic pause than a full surrender. Trump's decision to go to Beijing is a sign that he's scrambling to rebuild trust, or at least to de-escalate tensions. Why? Because the U.S. cannot simply replace China overnight. Even Trump now knows that trade wars don't always end on the U.S.'s terms when the other side holds rare earth cards. The very fact that Trump is making this trip shows he realized the pain his own tariffs and threats caused. And now, under pressure from both industry and national security, he is trying to reset. His hope is that Xi will eventually agree to visit the White House later next year. This will really mean a lot to Trump. In the middle of all this is U.S. Treasury Secretary Scott Bessent. He has become the diplomat behind the scenes, working to stitch together a deal that will unlock critical resources for America and, at the same time, save U.S. farmers who were hit by China's earlier trade retaliation. Trump's outreach to Xi Jinping is not just about rare earths. It quickly turns into a negotiation over agriculture. To ease tensions and rebuild trust, Bessent steps in with a deal centered on soybeans. This shift moves the story from minerals and global leverage to farm states and domestic politics, showing how international trade directly ties back to America's heartland. Bessent recently announced that China has agreed to buy 12 million metric tons of U.S. soybeans by January, under the deal struck by Trump and Xi. More strikingly, China has committed to 25 million tons per year for the next 3 years. That is a huge amount, and a big lifeline to American soybean farmers, many of whom suffered when China cut off purchases during past trade fights. But Bessent says the deal is more than just about farm goods. It's about leverage. In exchange for China buying your soy, Trump is softening some tariff threats and China is easing its rare earth licensing regime. Bessent also said that Trump's earlier threat of a 100% tariff hike has effectively been taken off the table now. Yet, this deal is built on shaky ground. The commitment from China is not rock solid. It is heavily dependent on trust, and history shows that trust with Beijing can be fleeting. There are concerns that China's promises to buy soybeans and delay rare earth rules might be reversed or diluted. Bessent himself warns that if China backs out, Washington still has lots of levers to respond. Bessent even called China's earlier export curbs on rare earths a real mistake. His argument: China's attempt to pressure the U.S. with mineral controls might backfire because the U.S. is now aggressively pursuing alternative supply chains. Indeed, he claims U.S. reliance on Chinese rare earths could end within 2 years. But even with that, he hopes the deal will be sealed by Thanksgiving. This makes the deal feel both hopeful and desperate. Hopeful because there is movement, desperate because so much is riding on China holding up its end. And Trump's trip is part of that gamble. He needs China, not only to keep mineral exports flowing, but also to prop up his political base in farm states. There is also a political risk for Trump. His base includes farmers who urged him to make a deal with China, but also nationalist voters who once cheered his tougher trade posture. By cozying up to Xi, he risks alienating parts of his base. And if China does not deliver, either on soybeans or rare earths, the backlash could be severe. The danger is real. China could easily pull back, reimpose tighter controls, or renegotiate on its terms. And even with Bessent's warning of lots of levers, the U.S.'s dependence on Chinese rare earths remains a strategic vulnerability. The soybean agreement may look like a lifeline, but it also exposes how fragile America's position has become. Even with promises of farm purchases and eased rare earth restrictions, the deal rests on trust that could vanish overnight. That uncertainty leads directly into the bigger picture: debt pressures, foreign capital dependency, and strategic vulnerabilities that define the U.S. economy today. Which means the soybean deal isn't the conclusion. It's the bridge to understanding the deeper risks America must confront. In short, Trump is trying to fix a very dangerous mistake of underestimating China's economic power and its control over critical resources. But this solution may not be stable. The U.S. is buying time, not security. And unless Washington uses this fragile moment to build real, resilient supply chains, and not just rely on Chinese goodwill, it risks being caught in the same trap again. The U.S. now faces a dangerous convergence of pressures: mounting debt, dependence on foreign capital, and strategic exposure to China's rare earth supply. These forces are shaping markets in real time, and they will determine whether the American economy stabilizes or slides into deeper instability. Because the real question isn't just about Trump's next move. It's about whether the United States can adapt quickly enough to protect the financial system it depends on. Share your thoughts in the comments and don't forget to subscribe, and see you in the next one.